Welcome back to the Deep Dive. Glad to have you with us. Today, we're doing something a bit different. We're digging into an investment story that's maybe less about broad market trends and more about a really clever, specific strategy. Yeah, we're looking at some analysis from Josh Young. He's highlighted this small natural gas producer. Thinks it's a really compelling, mispriced opportunity. So our mission today is to kind of unpack this setup. It looks like it promises some, well, pretty elevated cash returns, high potential upside too. But it does this while tackling a known risk head-on. We want to figure out why it might be overlooked and what's so smart about the risk approach. Get ready, because we're talking about a dividend yield that catches the eye, serious growth potential, and a way of handling risk that might make you look at things differently. Okay, so let's unpack this a bit. What we're fundamentally looking at is a small natural gas producer, right? And the big draw seems to be, first off, a dividend yield over 10%.
That's right, over 10%. And crucially, that dividend isn't just, a promise. It's fully supported by their actual cash flow, solid cash flow.
Okay, so it's sustainable, not funded by debt or anything like that.
Exactly. And that solid base comes with high potential upside. That's the unusual part.
Right, because normally you get one or the other, or if you get both, there's some hidden catch.
Precisely. High cash returns and high upside usually signals big, maybe unacknowledged risk. But what's different here, what's fascinating, is that this comes with a very clear framework for managing a very specific, very known risk. It's out in the open.
And that known risk is dilution from warrants, yeah? Can you maybe quickly explain what that means?
Sure. Warrants are basically like long-term options the company issues. They give the holder the right to buy stock later at a set price. If lots of those get exercised, it means more shares outstanding, so each existing share represents a smaller piece of the pie. Dilution, that usually spooks investors.
Makes sense. So how is that risk being managed here? This is the clever part, I gather.
It is quite clever. The strategy Josh Young uses is, well, he hedges against the dilution risk by simply owning the warrants too.
Ah, okay. So instead of just holding the stock and worrying about the warrants.
He holds both. It's like an internal hedge, gives him control. He can exercise his warrants if others do, keeping his ownership percentage stable, or potentially sell the warrants to offset any value dip in his shares from dilution.
So it turns a potential negative into almost a tool.
Exactly. A strategic advantage. Like you said, it transforms the liability.
Okay, that is a neat approach. But, I mean, doesn't owning warrants add complexity? Maybe cost? Is that why the market is missing this?
That's a very fair point. It definitely requires, a more sophisticated understanding. The market often looks at things in silos, sees stock, sees warrants as just a negative overhang, dilution threat, full stop.
They don't connect the dots on the hedging strategy.
Right. They seem to overlook that an integrated strategy can neutralize that threat. Josh's research suggests the company is trading cheap even on standard metrics like EV to EBITDA compared to its peers. It feels like the market's applying a discount for the warrants without seeing the hedge that's in play. Creates that blind spot, that mispricing.
Okay, that makes sense. Now, here's where I think it gets really interesting. Beyond just this smart financial structuring, are there bigger picture things happening, macro trends? Because Josh also points to rising demand for natural gas, specifically from AI data centers and LNG exports.
Absolutely. And these aren't small trends. They're potentially huge drivers. Think about AI data centers. The power consumption is just enormous, like a small city for one big center. And we're just at the beginning of that build out.
And natural gas is positioned to power that.
It's a key fuel, reliable, relatively cleaner than coal. It's a bridge fuel that's needed now for that kind of massive constant power demand.
And the LNG exports.
Same story, different angle. Global energy security, shifting away from coal. Countries need LNG. Exports are booming, becoming geopolitically vital.
So these trends could push natural gas prices higher overall, giving this producer another tailwind.
That's the potential upside, yes. Higher commodity prices on top of the company's specific situation, it could really enhance the investment's value.
So pulling this together, what we've really looked at today isn't just, one stock pick. It's more like a case study in finding value where others aren't looking. We saw this unusual mix, high yield, high upside. Then, a known risk, the warrants being actively managed, even turned into part of the strategy.
Right, through owning the warrants themselves.
And then layered on top, these potentially powerful macro trends in AI demand and LNG exports. So what's the takeaway for you, the listener?
I think it's about the value of really deep analysis. Looking for those situations where maybe the market has mispriced something because it's overlooking how a risk is being actively handled. Exactly. And maybe it prompts a broader thought. Thinking about your own areas of interest, whatever they might be, not just finance. Where else might there be a hidden gem, an overlooked asset, an idea, where there's a known challenge, but also a clever, actionable way to navigate it that most people are missing, something to keep an eye out for.